Stephen King, Chief Global Economist at HSBC, joins us now to tell us more. Stephen, in terms of what this helicopter flooding, the problem is we still have inflationary pressures in the US, which we didn't even have at the time of QE2.
Well, if there's one piece of good news that came from QE2, it was the fact that there were fears of deflation last year, and those fears of deflation have now gone. I must stress that I'm not suggesting that the Fed should pursue the helicopter money process. I'm simply saying it's an option that's out there, but it's an option that's beset with terrible risks. The most obvious risk, which we've already seen over the last year or so, is that if you print money, try to stimulate the economy, you may end up with more inflation and not much in the way of growth. And in fact, if you think about what's happened over the last couple of years, we've had a pickup in inflation, but the growth numbers in the States remain extremely depressed.
So what exactly, how many options does Ben Bernanke have? We're talking about this, just straight out QE3 with a twist, or this helicopter, Ben Bernanke?
Well, there's helicopters, there's QE3 with a twist, there's QE3 itself, there's a possibility of purchasing foreign bonds rather than domestic bonds, effectively trying to weaken the dollar. Some have suggested that if you buy European bonds, the Federal Reserve can solve Europe's crisis as well as its own crisis, which is a
but the likelihood of that happening?
I would say very low, because part of the problem here, of course, is the Federal Reserve has to answer to Congress. And Congress gets very, very nervous if the Federal Reserve is expanding its balance sheet and buying all sorts of what you might describe as pretty weird and esoteric assets of one sort or another. So there are some big dangers there. The other alternative that Bernanke has got is simply to be realistic. If you go back to the 2002 speech that he gave, which was talking about avoiding deflation in the US, he said that Japan's specific problems were not just technical problems associated with an inability to stimulate monetary policy, they were also significant political problems reflecting huge disagreements about how to restructure the Japanese economy. Now, he said at the time that this was not true of the States and not true by implication of Europe either, but today it really is true.
But he still, I guess, needs to give some kind of an indication that he has ammunition left, and that although he won't say anything today about what exactly he can do, that he's ready to act, because markets are expecting something, and that must put extra pressure on the central banker.
Well, he can't be responsible for what markets expect necessarily, but to be fair, they already have done something fairly aggressive, which is to make this promise they're going to keep short-term interest rates at current levels all the way through to 2013. Now, other central bankers have criticised the Federal Reserve for doing this. They've said, well, look, how can you possibly make that kind of promise? Bernanke's defence would be to say, well, if we don't make the promise, we can't keep long rates lower for longer over the next few years. So the idea is that you get lower long rates through this promise, and that hopefully stimulates more activity. But the reality is you can stimulate as much as you want, but if consumers, the government and others are intent on deleveraging, on repaying debt, you never get the kind of recovery that you'd normally expect.
Stephen, what do you exactly hope or do you think that Ben Bernanke will do? We got a hold actually at Bloomberg of his tutorial scholarship when he was a scholar, and he said central bankers need to be bold. In fact, he was talking about Japan, saying they should have been much bolder. He's been bold so far. How far can he go?
Well, when you get into things like helicopters and so on, you're effectively printing money like crazy. That's the ultimate bold step, but it's a bold step that in the 1920s led to the hyperinflation of the Weimar Republic, hyperinflation in Hungary after the Second World War, hyperinflation in Latin America in the 1970s. You can sometimes be too bold. I think at the moment there's a chance perhaps for thinking rather calmly about what is possible and what is simply a triumph of hope over reality. What is possible at the moment is actually more limited than perhaps the markets think, because what we're seeing at the moment is, I think, a significant structural loss in the pace of economic growth in the States and in Europe. This, again, is reminiscent of the Japanese experience. People thought you could fix Japan, but actually it was the long-term growth rate that was much weaker than people thought.
I understand that they're not here to help the markets, but if the markets are expecting something, you still have to signal something that will actually, soothe the markets, because otherwise your economy gets even worse.
Well, you can try to persuade the markets that something can be done, but the reality is that markets eventually will wake up themselves to what is actually the truth. You think about how markets have reacted over the last year or so. What did QE2 do? Well, of course, it lifted equity prices for a number of months, which was relatively good news. But as this year has progressed, equity markets have discovered that the recovery in the economy that they thought was coming actually hasn't materialized. So effectively, the equity market has unwound many of the gains it made last year.
Now, before we get on to the problems of the Eurozone, I wanted to ask you about the chances that the world economy will fall into recession in the next couple of quarters.
They've obviously gone up. If you take one indicator that everyone looks at, is the Philly Fed survey. Philly Fed survey has collapsed. When it's collapsed in the past, you've typically had a US recession. If you have a US recession, chances are you have recessions elsewhere. I must stress this, not part of our forecast currently, but in terms of risks, definitely they've gone up over the course of the last few months. The I'd stress, though, is that people often assume that if you can avoid recession, everything's going to be absolutely fine. That really isn't true. The problem at the moment is not so much recession or recovery, it's stagnation.
Yeah,
it's
that we're
the
not
absence of
growing.
recovery. That's the real problem. And the absence of recovery means that people have very high levels of debt, they can't deleverage very easily, their income levels are not sufficiently high, and financial markets worry about who ultimately has to carry the can. And that uncertainty leads to continuous stagnation, again, rather similar to the Japanese story over the last 20 years.
And it seems there's much more uncertainty here in Europe, because although there's been political wrangling in the US, here in Europe, we don't really know who's in charge. Politicians, as you were saying, aren't acting together at all.
And part of the problem there is that you've got some European nations who are basically debtor nations, who've borrowed heavily from others, and some who are creditor nations, who've lent heavily to others. And it's not clear exactly whose responsibility it is to resolve this Eurozone crisis. The Germans can quite happily say, well, the Greeks and the Irish and so on borrowed too much, but who was lending to them in the first place at very low interest rates? It was, of course, the German financial institutions. So it's not entirely clear precisely whose fault it is. And of course, what it reveals is an uncertainty at the very heart of the Eurozone treaties, which is that in these kinds of circumstances, not clear who's
just wasn't
responsible.
planned for.
Absolutely right, yeah.
Stephen, in terms of what we are seeing on Greece, I mean, we seem to be going into phase 1, phase 2, phase 3. What kind of phase are we now? Is it just a problem with Greece and the collateral there and the fact that the Finns want to change some kind of agreement, or is it a problem that's going to also hurt France and Spain? Is there going to be another realization that actually these yields will have to go up before governments take action?
There's a specific problem, specific issue in Greece, which of course is that the Greek fiscal numbers have been subject to some degree of scrutiny over the course of the last few years, is a pretty polite way of putting it. And therefore there are particular reasons for worrying about Greece. But as far as the Eurozone as a whole is concerned, of course markets are worried about whether the actual euro will survive. I think a lot of people will take the view, well, it can't survive in its current form, so either it falls apart or there have to be major changes, major surgery to how it operates, which I think probably includes a move eventually towards some kind of political and fiscal union. Now, I think politicians are slowly moving in that direction, but it's going to take a lot of effort to get there.
We're all hopeful that actually we can move away from Greece and I guess focus on the others. What are the chances of us needing to chuck out one or two countries to survive as a Eurozone?
Well, the Eurozone is supposed to be a family, and in a family, anyone who badly behaves, you still try to look after until all options have been exhausted. The reality is that if one country were to be chucked out, it would raise the risk of other countries being chucked out at some point in the future. And the whole idea of the euro is that you lock yourself in, you throw the key away. So once you reveal that one country might be able to leave, you've got problems all over the place. So I think the ideal situation is to try to resolve these problems before you get to that particular point.
All right, Steve, thank you so much. Stephen King there.